Hey, smart savvy income investors, welcome back to the Harvesting Income channel. Today we are going to talk about QDTE, and this is based on the Innovation 100 or the Nasdaq 100 0DTE covered call strategy ETF, and this is based on the Nasdaq 100 index. And I'll explain to you the features when we get in. But this is more like battling rapids, because the index itself is pretty volatile, and writing covered calls on this index and making premium income and on a weekly basis. That's pretty interesting. So, so this is from the Roundhill Investments, this fund, and they invest in the Nasdaq 100 index and write covered calls every day. So, if you want to know more about the capital appreciation, dividend yield, and pros and cons, and a lot of other information, stay tuned till the end. Okay, before we go ahead, quick disclaimer: this is not financial advice. This is just for learning purpose. And let me quickly go through the basic strategy of the fund. First, for the fund name is Roundhill Innovation 100 0DTE Covered Call Strategy ETF. That's a mouthful. So, so let me break it down. Firstly, the Roundhill is the name of the company, the Roundhill Investments, which is the fund, and they call it Innovation 100, but basically it's the Nasdaq 100 index that the fund is investing in. So that's the underlying index or the asset. And 0DTE stands for 0 day to expiry, which means they write 0 day to expiry covered calls, and these calls are basically having a 1 day expiry. Basically, they are they start every day and they expire on the same day. Basically, they trade for one trading session, and that's why they are called 0 day to expiry covered calls. And I'll explain to you further as we go ahead. The fund has basically two-pronged strategy, just like any other covered call fund. The design is somewhat similar. However, this fund does not hold the Nasdaq 100 components or the stocks. They don't hold a Nasdaq 100 exchange traded fund internally or an external fund they hold. No. Basically, they have a long exposure to the Innovation 100 index through long-term covered calls. So they basically write deep in the money long-term covered calls, so which enables the fund to track the price of the index. So whenever a fund buys a long-term covered call, which is not covered call, I mean long-term call, it would actually track the price of the underlying asset, roughly like. So in this case, since they are tracking the Nasdaq 100, the call option on the Nasdaq 100 that they are buying for the purpose of underlying holding is going to track the index. That is one part. So when the index moves up or down, this position is going to make profit or loss accordingly. And it changes every day. Okay. That's one part of the story. And the other part is basically they are able to generate income by selling calls each morning. And what kind of calls? That would be out of the money calls that they sell every morning. And these are called the 0 DTE calls, which have a special feature. They expire at the end of the same trading session. So when they do write these everyday calls, they're able to capture daily option premium income or the option premium, which is the basic income for the fund. In addition to the tracking of the index that they already do. So combining these two, it works exactly like a covered call. And this is also known as the synthetic uh, covered call strategy. The first position, some people call it as a synthetic long position. So when that is combined with the call options which are sold, it becomes a synthetic covered call strategy. And it works exactly like the regular covered call strategy, but there are few differences in the fact that you don't hold the physical stocks or the physical exchange traded fund. So it's basically little efficient or cheaper to hold. That's a bigger topic, whether to go for the physical or the regular covered call fund or the synthetic covered call fund. That's a topic for a different day. But for now, this fund is actually using the synthetic covered call strategy, and they use that to produce income on an everyday basis. Okay. The ticker symbol is QDTE, and price is around $34 as of June 5, 2025. Fund was launched March 2024. It's more than 1 year now since the fund has been launched. It's about 1 year, 3 months. So it has a fairly good amount of history and, you know, uh, track record that we can look at to know if the fund has been doing well or not. And net assets about 759 million, which is pretty decent size. Expense ratio is 0.97%. The reason it is pretty high is because of the daily trading involved and an active covered call strategy, dynamic covered call strategy involved. So that's why it is a pretty higher. All said and done, so far the information looks good. Just that the expense ratio is looking a little higher. And if you want to know more details about the fund, you can visit the website roundhillinvestments.com. Now let's look at the price returns and the dividend yields. That's what you have been waiting for. I can see that. So QDTE lost 24% over last 1 year. So 1 year ago they were at $44.93. Now they are at $34.13. It's highly disappointing. Whereas in the same period, if you look at the Nasdaq 100 1 year ago was around 19,021 points. Now it's about 21,547. Actually, these are not the dollar numbers. These are the index points. That's a small correction here. But 13.3% is far better than the 24% negative. There's something wrong with the fund. That's not good. However, one thing to keep in mind is that when there is a fall in the index, sometimes the covered call funds have to fall too, like because they follow the index. However, when the fund is going up and still the fund is not performing well, so that's something, kind of disappointing. But of course, this is just one side of the story. We still need to look at the distributions. Nasdaq 100 returned 13.3%, and obviously Nasdaq is winning this part, like the price return part of it. And Nasdaq funds, Nasdaq index, Nasdaq stocks, all of them are volatile, just like the river rapids. So it's just like going through an adventurous trip. So that's what you will feel when you invest in these kind of funds. So that's a disclaimer. And again, this is not financial advice. Uh, Dividend yield. Okay, now I did the math for all this. How do you calculate the dividend yield for this fund? So you basically go to the fund website, look at the dividends, and the fund pays dividends every week. So what I did is I went back. Right now we are at June 2025, early June. So now from June 2025, I went back all the way to last year. So that means I have to cover 52 weeks of dividend. So if it is a monthly dividend payout, I would have just done a sum of 12 dividend payouts if it is a monthly. Since we are talking about weekly dividends, like I have to go back 52 weeks, sum up all the dividends. So that comes to about $15.27. And the fund is about around $34. So roughly its dividend yield is coming up to 44.7%, which is extremely good. 44.2%. Is it too good to be true? I don't know. It looks really, magnificent, in terms of the returns. But of course, you saw the price erosion that is dragging down the returns in the other page. So all these numbers are right. I have checked it myself. And when I check the total returns, I would get the full picture. Now, in the previous slide, we saw that the fund lost 24%. Now, let's look at the total return to get the total picture. Okay, total returns of 20.7%. So the fund lost 24% on the price front. They made it 44.7% on dividends. So net they are making about 20.7%, which is pretty good. 20.7% per year, which is pretty good. And of course, this is all paid out every week to you. So that's another advantage. Like whether it's paid weekly, monthly, it doesn't matter so much. However, the weekly payouts can be a advantage, especially if you're an income investor or if you're looking for the cash flows, if you're looking for the regular flow of money, and you want that regular flow of money to reinvest into other stocks, other funds, other opportunities, this fund is an option for you. There are other funds too, but this is one of the options for you. Now, the high dividend yields distributed weekly, it seems to be very attractive, but I mean, is it really possible to, deliver weekly dividends? That's the question. The answer is yes, because we have seen 1 year of track record of this fund, and it is possible for these funds to earn income every day. So there is one small caveat I would like to add here. So when I say the fund is generating income every day, it doesn't mean that every day they are going to make X amount of income and keep accumulating that money and paying the dividend. It works somewhat like that, but there is one thing you need to keep in mind. So every day when the Nasdaq index moves up or down, the QDTE can also move up or down. Okay, so that's one part of the equation. The second part is when the fund sells calls, does it mean that every call, every trade is going to make profit? No. Every day they are going to trade or sell the call options, right options, and they make premium income, or they may lose some money on the position. So if the return call option goes against them, or if the Nasdaq rallies on that day and they return the call option at a lower price, then they're going to lose a little bit of money on that. So that's going to happen. There's going to be a little bit of plus and minus, a few days of profit, some days of loss. So as long as they are able to maintain that profit streak, they can pay that weekly dividend comfortably. But there can be times when the Nasdaq moves against the um, strategy that the fund is making, and sometimes there could be days, couple of days or 3 days of loss, and that can drag down the returns of the fund. So this is just a general idea that I'm giving you. I don't have the numbers. I don't have the trading data or information to back up what I'm saying. But of course, the performance can go up and down. The performance can vary, and the dividend payouts also can vary. So that's something to keep in mind. Every week, you're not going to get the same amount of dividends. So it can vary, all the way. It could be 10 cents in a month, sorry, in a week, or it could be 20 cents in a week. It all varies. So smart investors seem to buy when the Nasdaq falls. This is what I observed. Like mostly these funds, when they launched, it's a lot of hype and a lot of attraction towards these funds. People jump into the funds, and the fund price also goes up. Wait for a few months, and after a few dividend payouts, the price erodes gradually, and probably some early investors, uh, probably they come out of the fund, they're not interested anymore, or sometimes the dividend dips and then the price comes down because people start selling. Whatever happens, after some time these things stabilize, and once you see that the price has stabilized and it has come down, you can buy it at an attractive price, because right now it's at $34. In the initial days the fund was trading, started at $50 and gradually came into the 40s and gradually fell down. That's the nature of covered call funds. That's how it's going to behave. So that's why it's important for you. I say in all my previous videos that you have to give it some time to, make its own history and track record. And once you see that history and track record, let's say 6 months, 1 year, you would get a kind of vision on what's going to happen and what you can expect. What is the extremes? What are the worst case scenarios? What is the best case scenario? What is the base case, average case? And then you get into the fund. Then you have a pretty larger amount of confidence to hold on to a longer period of time and generate that income and yield, which would be much more attractive when you buy it at a lower price. Anyway, so this is the story that the fund is able to generate 24% negative return on the price front, and they distribute 44.7% in terms of the dividends. So net net you are getting about 20.7%. So now the now we have understood most of the basic features of the fund, and I'm going to give you a quick comparison of this fund versus the other fund, XDTE, QDTE versus XDTE. I'm going to quickly compare just the returns. I'm not going to compare everything. But before I do the comparison, just keep in mind that these are two different indices. QDTE is based on the Nasdaq, XDTE is based on the S&P 500. But still, I'm doing this comparison to give you the differences. So, I mean, you can judge for yourself which one works well for you. Okay, now here comes the interesting. Okay, now here comes the interesting part. Now, Nasdaq 100 is known to be more volatile, than the S&P 500. So that's why you can see 24% QDTE price return and XDTE price return around 18%, 17.6. So that clearly tells you the difference between the volatility of these two indices. Like, so QDTE moves up and down pretty fast. XDTE would be more stable. In my view, I could be wrong here. In my view, XDTE is more diversified because the S&P 500 is more diversified compared to the Nasdaq 100, which is more tech centric. However, some people argue that some of the Nasdaq stocks still dominate in the S&P 500. It's a kind of a debate that's going on. I like the XDTE more, but at the same time, I don't mind having QDTE in one of my other portfolios. So I have a bit of both actually. So that's a honest disclaimer that I like XDTE for its stability, whereas I like QDTE for its high amount of dividend potential and high volatility, premium capture, all those reasons. So when the index is more volatile, like it's a kind of a double-edged sword. You can get more premiums, but at the same time, your fund can erode value too. Especially when the index falls, you can see a little bit of price erosion. But as long as you're confident about the basket that you're investing in, and you're investing in the index or the basket, what do you really need to worry about the price fall? Because over the long term, you're going to hold the index for like 5 years, 10 years. It's going to go up. So you are going to buy it at a lower price and see that price appreciation and also get all the dividends and premium income along the way. So anyway, here the higher distributions come from the higher premiums due to the higher volatility. Exactly what I explained. And the dividends are slightly lower for XDT because again the volatility is slightly less for S&P compared to Nasdaq. And the third point is very interesting. The frequency of payouts and higher distributions. That's eroding the price of the NAV. Of course, both are weekly payers. Since there is a weekly payout, the frequency of the payout can actually erode the value of the fund. However, that's not always the case. Sometimes there are times when overnight the markets go up. The markets go up overnight, index goes up overnight. Then XDTE benefits from that, or QDTE will benefit from that. So that overnight upside mitigates the price erosion. And that's why you have seen that in the initial days or initial months of the fund launch, if you have been following this, XDTE was able to curtail the erosion. They were able to completely mitigate the erosion. They were even trading above $52. They launched it around $50. They even went all the way above $52 and so on. And they were able to arrest the price erosion somehow, because of the overnight you know upside exposure, and also the fund was performing well and they were able to make good amount of income. But these strategies sometimes work, sometimes may not work. Only the time will tell. I mean, this is not to say that you will get these kind of returns every year or every period. So whatever you are seeing is only historical information, not a financial advice at all. Please consult your own financial advisor or do your own research and do your own analysis and come to a conclusion. And don't go by these numbers to make any decision. This is all past numbers. So with that, I'll just come to the pros and cons. and then we will look at the conclusion and my thoughts on that. Okay, quickly the pros. We are familiar with most of them, but I'll quickly summarize this. High distribution income, that's the key advantage for the QDTE. And zero DTE options allowed for higher income capture, because instead of doing monthly calls, if you're doing daily calls, you have a higher chance of making profit. And the another point that I wanted to quickly emphasize is, let's say there is a monthly uh, call writing fund, let's say like XYLD, XYLG. So if they write calls every month, so they can do well on good some months, they can do okay on some months, and they don't, and probably they make small losses on certain months. So no fund is so perfect that every month they can give positive returns without any risk or loss. That's not how it works. So it could be just like throwing darts, like 7 out of 10 times you might be right, or sometimes 5 out of 10, sometimes 3 out of 10. We never know. So so what happens in this case is, if the fund is able to do it daily, so you have 30 days in a month. So in 1 month, the monthly fund is able to write only one call, whereas this fund is able to write like 20 different calls. We don't have 30 days in a month, but we have trading days of around 20 something, depending on the holidays, weekends, whatever you have. So if they are writing, let's say, 20 days in a month. So out of the 20, probably if they have a 75% strike rate, on 15 days they are able to make profits. 5 days they make small losses. So net net, when you add the profit minus the loss, you still make a profit. That's a great strategy. That works pretty well. And even if, let's say, one day trade doesn't go well, the next 2 days they can recover. And then the third day they can make profit, fourth day they can do well. This is just an idea that I'm giving you. I'm not saying that due to this you have to invest in this fund, but not a financial recommendation. This is how it works, because if you write calls every day, then you have a daily opportunity to correct your trading, and then you can make profits over time. It's just a law of probability, law of decision making that you try to use in your favor. The probabilities are going to be in the fund's favor. Anyway, so long story short, that daily income capture works really well, and they're able to participate in overnight index gains. I already explained that. And exposure to high tech sector via safer index basket. Instead of investing in the new Teslas or new tech companies that you have never heard of, you can safely invest in this basket, and you don't have to choose one particular stock. You can just invest in the basket, and the fund can limit the upside like any other covered call fund. This also has a limit on the upside, and especially on the capital appreciation, you can see negative returns, and overall total returns also can be limited when the market is going up steadily over a period of time. So those are the pros for you guys, and for the con side, I have the first one, which is the higher expense ratio, close to 1%, like it's 0.97%. It's a pretty high. Uh, it's not a big concern. Like if you're making good returns, then the expense ratio will be part of it, and net returns are still high enough. So I don't see that as a big con, but I still have to give you the full picture. So that's the kind of a con. And when you're making low returns, this expense ratio will actually erode into your returns. And variability of distributions. This is an important point I mentioned before, but I just want to emphasize again. Weekly dividend doesn't mean the dividends are going to be high. Dividends can be low, and dividends can be drastically reduced, or it could be stagnant, or it can be lowered pretty much anytime. Like, so that's something you need to be prepared for. So if you're expecting that you're going to get certain amount of dividends, I don't think it works like that, because these funds distribute based on the amount of premium they earn. So it's not like a distribution based on some weird formula or some weird method. Yes, they do have some method or some policy around it, but it is based on the amount of premiums earned by the fund. So based on that, they would decide how much of distribution to make. So that's how it works. And the third point is concentrated exposure to the tech sector. That could be a risk. Obviously, Nasdaq 100. But obviously, most people who are investing in this are aware of that. And capital erosion risk due to the unpredictable volatility of the index. So these are the risks that you will face. So just to give you the clear picture, like if you are feeling that two or three of these cons are really bothering you, then probably this fund is not for you. However, if you just feel that just the higher expense ratio is a concern, I would just say just take a look at it, do your own research, wait for a few months, and then you know do your own analysis, and then see the pros and cons, benefits, and the issues. And if the benefits are outweighing the issues, then probably you can reconsider. So that's the summary of the pros and cons. I hope you liked the video, and I hope you liked watching the details of the QDTE, and probably you're considering looking at this fund. If you have any comments, any feedback, any questions about this fund, please drop in the comment section below. And if you want to know more, you can follow this channel, subscribe to it, and share it with your friends and family. And I also have a Facebook page. You can come and check out this page. I have dropped it in the links below and also on the channel pages. And you can follow the channel in any of these you know social media platforms. And happy investing. Have a great day. Thank you.